Usually when we look at a weather map, we expect a certain level of predictability.
Right, yeah. It's cause and effect.
Exactly. You see a massive dark cloud with a lightning bolt icon hovering over your city. You grab an umbrella. It's simple. You just don't have to overthink it.
It's totally intuitive. You have historical data, atmospheric pressure readings, and the meteorologist synthesizes all of that.
They give you a little icon.
Yeah, a simple icon so you know exactly how to prepare for your day.
But then you step into the world of day trading, and suddenly, for a lot of people, that weather map is it's a chaotic, swirling mess of green and red bars.
A total nightmare for beginners.
Right. They open up a 1-minute chart, their heart rate spikes, and they're essentially trying to predict a Category 5 hurricane by staring at, like, a single raindrop falling on their windshield in real time.
Which is an incredibly stressful way to operate. I mean, it is the absolute definition of losing the macro narrative.
Because you're hyper-fixated on the micro.
Exactly. You are reacting to every tick, every tiny movement, completely oblivious to the massive pressure systems forming right above your head.
And that feeling of being lost in the storm is exactly why I wanted to do this specific deep dive today. I've been going through this massive stack of research you sent over.
Oh, there is a lot of material there.
There really is.
Yeah.
And the mission for us, and for you listening, is to find the ultimate compass. We are unpacking what many consider the holy grail of day trading.
Establishing a true mechanical daily bias.
Yes, a daily bias.
It is the single most important filter a trader can have. Without it, I mean, you're just gambling with extra steps.
So just to give everyone an idea of the arsenal we're working with today, we're pulling from some incredibly detailed sources. We've got a comprehensive mechanics breakdown by an analyst named Trader Zed.
Great stuff in there.
Yeah, really solid. And we're also looking at strategy transcripts from 4 top-tier trading Minds Trading Hub, T-Trades, Lewis Kelly, and JDub Trades.
And we didn't stop at just human analysis, right?
No, we didn't. Because we want to remove the human error element, we're dissecting the logic behind some highly advanced TradingView indicator scripts.
The algorithmic side.
Right. Scripts designed to track institutional order flow, multi-timeframe alignment, and liquidity.
The goal here is to take all of that complex, high-level institutional theory and distill it. We need a step-by-step mechanical framework.
So by the end of this conversation, you should understand exactly how to determine whether the market sentiment is bullish or bearish on any given day.
And how to use specific price action to validate that bias.
Crucially, how to execute an entry without letting your emotions dictate your risk. Okay, so let's unpack this starting from the ground up.
Let's do it.
Going back to my meteorologist analogy, if you want to know the weather, you don't just look at whether it's raining right this exact second.
No, you look at the macro data.
Right. But in trading, the temptation to just open a chart and guess is so strong. Why is establishing a daily bias so incredibly difficult for the average retail trader?
Well, because the market is specifically designed to confuse you. I mean, if we look at the bigger picture, the lower time frames.
Like the 1-minute chart.
Yeah, the 1 minute, the 5 minute, they are filled with infinite noise. They are literally designed to trigger your fight or flight response.
So when you don't have a daily bias anchoring you, every single large green candle looks like a massive breakout.
Exactly. You get FOMO, fear of missing out, so you buy. Then, 2 minutes later, a huge red candle prints and you think the market is crashing.
You panic sell.
And you end up getting chopped to pieces by the algorithm.
Death by 1,000 paper cuts.
Precisely. But when you have a daily bias, you suddenly have a filter. If your bias for the day is strictly bullish, and you see a massive red candle dropping on the 1 minute chart.
You don't panic.
You don't panic. You understand that it is likely just a temporary manipulation, a trap.
Designed to get amateurs to sell before the real upward move begins.
Exactly. Your bias gives you the psychological armor to survive the intraday noise.
So how do we actually find this bias? Because in Trader Zed's breakdown, and also in Lewis Kelly's transcript, they introduce something that sounds, honestly, almost too good to be true.
The one candle rule.
Right. They claim you can predict the market's next move with staggering accuracy by looking at just one thing, the closing body and the wicks of the previous day's candle.
Just one single candle.
Mechanically, how is that even possible?
I know it sounds overly simplistic, especially when traders are used to having 20 different moving averages on their screen. But think about what a single daily candle actually represents.
It's the whole day's data.
It is the ultimate finalized summary of the previous 24 hours. Human emotion, institutional algorithmic trading, global economic data releases.
Corporate news, everything.
All of that incredibly complex data is distilled into 4 data points: the open, the highs, the low, and the close.
It tells a complete story of who won the battle that day.
Exactly, the buyers or the sellers.
Okay, walk me through the specific cues they look for. Trader Zed talks about a continuation signal. He says if a daily candle closes above the previous day's high, the bias for tomorrow is a bullish continuation.
Yep.
And if it closes below the previous day's low, the bias is bearish. But why does the close matter so much more than just the price poking its head above that line during the day?
Because the closing price is where the institutions are comfortable leaving their money overnight.
Oh.
During the intraday session, price can spike up above yesterday's high. That might just be a brief surge of retail excitement or, a temporary algorithm sweeping some orders.
So it's a temporary blip.
Right. But if the price manages to stay up there and the body of the daily candle officially closes above yesterday's high, it shows absolute conviction from the smart money.
They're planting their flag.
They are planting a flag. It means that buyers were in control right up until the closing bell. They didn't just push the price up and then get exhausted and retreat.
They held their ground at a premium price.
Exactly. That kind of momentum, that underlying inertia, doesn't just evaporate when the clock strikes midnight. It typically carries over into the next trading session.
Therefore, your bias for the next day is a bullish continuation.
Spot on.
That makes perfect sense for a trend that's already moving. But here's where my mind got completely blown reading Lewis Kelly's notes.
The SOS signal.
Yes. He details a scenario where the market tries to push lower, fails, and creates what he calls the SOS signal. And he says this is a massive reversal indicator.
The SOS signal is arguably one of the most powerful price action signatures you will ever encounter.
Let me paint the picture for the listener based on his notes. Imagine yesterday's daily candle. Today, the price drops. It goes below the absolute lowest point of yesterday.
So on a chart, it looks like a total breakdown.
Right. But then, before the day ends, the price violently reverses back up, and the body of the candle actually closes back inside yesterday's range.
Leaving behind a long wick.
Yeah, this long, thin line at the bottom. Why is that specific visual so incredibly important?
To understand why that's important, we really have to look under the hood at the mechanics of order flow. We have to ask ourselves, what actually lives below yesterday's low?
The stop losses, right? People protecting their trades.
Yes, specifically sell stop orders. Think about the thousands of retail traders who bought the market yesterday.
They want to be safe.
Exactly. So they placed their safety net, their stop loss, just below the lowest point of yesterday. They think, if the price drops below this point, I'm wrong. Get me out.
Makes sense.
Now, when a stop loss on a buy position is triggered, it automatically becomes a market sell order.
Wait, so if the price drops below yesterday's low, it triggers a massive avalanche of automated selling.
Correct. And this is the fundamental truth of the market. For every seller, there must be a buyer.
Right.
If a massive financial institution's smart money wants to buy tens of millions of dollars worth of an asset, they cannot simply click buy at the current market price.
Why not?
If they did, their massive order would instantly consume all the available sell orders. The price would skyrocket before their order was fully filled. They would ruin their own entry price.
They'd experience massive slippage.
Exactly. So they need to find a pool of sellers willing to sell to them at a discount.
And where is the biggest pool of guaranteed automated sellers?
Resting right below yesterday's low in the form of those stop losses.
So the algorithms engineer a drop in price. They push the price below yesterday's low. The retail traders panic, their stop losses trigger, and a flood of sell orders hits the market.
And who is waiting there to absorb all of that selling pressure?
The institutions. They are buying the panic.
Exactly. They are buying up all those discounted sell orders. Once their massive long positions are filled, they stop pushing the price down and the market violently reverses upward.
Wow. And the visual scar of that battle, that massive transfer of wealth from retail to institutions, is that long wick at the bottom of the daily candle.
And the body closing safely back inside the range.
It's a trap.
It is a meticulously executed trap. That is your SOS signal. When you see that daily candle close, the market has just handed you a billboard.
Saying what?
It says, we swept the liquidity, we rejected lower prices, our bags are packed, and tomorrow we are driving this price up. Your daily bias for the next day becomes an aggressive, bullish reversal.
Okay, I love this, but I have to play devil's advocate here for a second. Because if I open a chart, I'm not just looking at two candles.
Right. Context matters.
Yeah, and JW Trades specifically warns about getting tunnel vision. He has a rule that before you even look at yesterday's candle, you must zoom out. You have to look at the past 20 to 40 trading sessions on the daily chart.
Which is vital for context. A single daily candle gives you the immediate localized weather forecast for tomorrow, but the 20 to 40-day look back gives you the climate.
Are we in a bullish season or a bearish season?
Exactly. You determine this by simply looking at the structure. Is the market making consistently higher highs and higher lows?
If so, the macro trend is undeniably bullish.
And if it's making lower highs and lower lows, the macro trend is bearish.
Right, and this is where I always get confused, and I think a lot of listeners do too. What happens when there is a blatant conflict between the climate and the weather?
Ah, the classic dilemma.
Let's say the daily chart has been dropping like a stone for a month, lower lows, lower highs, a pure, undeniable 40-day bearish macro trend.
Okay, a heavy downtrend.
But then yesterday, we get that exact SOS liquidity sweep you just described. We wick below the low, trap the sellers, and close inside.
So the single candle is screaming bullish reversal, but the 40-day trend is screaming bearish continuation.
Yes. Which bias wins? If I'm sitting down at my desk the next morning, am I a bull or am I a bear? Isn't buying into a 40-day downtrend essentially trying to catch a falling knife?
That is the multi-million-dollar question, and it's the exact scenario where amateur traders completely blow up their accounts. Let's break down the hierarchy of price action.
Okay, I'm listening.
The overall 40-day macro trend always dictates the safest trade. Trading in the direction of the long-term trend, a continuation trade, will mathematically always have a higher probability of success.
Because you have the inertia of the entire market behind you.
Precisely.
So you would just ignore the SOS signal and keep selling.
Not necessarily. You don't ignore it. You contextualize it. The one candle SOS rule acts as an early warning system.
Okay, an early warning.
Yeah, if you get a bullish SOS signal inside a heavy bearish macro trend, it does not mean the 40-day trend has magically ended and we are going to new all-time highs.
What does it mean then?
It simply means that a retracement is likely starting. The institutions have grabbed enough liquidity to cause a temporary bounce, like a relief rally.
So I could take a long trade based on the SOS, but I have to know I'm swimming against the current.
Precisely. You are taking a counter-trend trade, and if you choose to take that trade, your risk management and your psychological expectations must shift immediately.
I can't aim for the moon.
No, you are not holding this trade for a week. You are aiming for the very next level of logical resistance, and then you are taking your profits and getting out.
Before the macro bearish trend resumes and crushes you.
Exactly. It requires a lot more agility.
It requires intense discipline. And frankly, for many traders, if JW Trades advice is applied strictly, when the signals are violently conflicting, there is no trade.
You just sit on your hands.
Capital preservation is a position.
It is the most profitable position you can take in a confused market. You wait until the daily candle and the 40-day trend are aligned.
So when the 40-day trend is bullish, and yesterday gave you a bullish SOS sweep.
That is when you size up. That is when you have true statistical edge.
Okay, let's assume we have that alignment. We've done our homework. The 40-day trend is up. Yesterday swept a low and closed high. We are firmly, confidently bullish for today.
A perfect setup.
Right. Now we move into the actual trading session. This brings up something I think a lot of people struggle with. Knowing the market is going up today doesn't mean I should just mash the buy button the second my alarm goes off.
If you do that, you will be right about the direction and still lose money. Markets rarely move in a straight line from the opening bell to the closing bell. If they did, this would be easy.
So we need to talk about the anatomy of a trading day. Our sources refer to this as the power of three, or the AMD concept. Accumulation, manipulation, distribution.
Yes. The AMD cycle.
I want to spend a lot of time on that middle phase, manipulation. Because according to T-Trades and Trading Hub, if my bias is bullish for the day, I actually want the market to open and immediately go down.
Yes, you do.
Mechanically, psychologically, that feels horrible.
Mm-hmm.
If I'm bullish, I want to see a wall of green candles the moment the market opens. Why do I want it to drop?
Because that psychological desire for immediate green candles is exactly what the algorithm preys upon. Let's walk through the exact anatomy of a bullish trend day.
Okay, walk me through it.
The market opens. If the price immediately shoots straight up, it is very difficult to catch safely. Worse, it's often a trap designed to get overly eager retail traders to buy at a premium price.
So what does the smart money do instead?
They initiate the manipulation phase, They deliberately drive the price down right after the open.
To shake people out.
To shake out the weak hands, yes, but also to trap breakout traders who are playing the wrong side.
Yeah.
Think about a retail trader who doesn't have a daily bias.
They're just staring at the 1-minute chart.
Right. They see the market open, and suddenly there are 3 huge red candles dropping below the opening price. They panic and think, oh no, the macro trend is reversing. It's a bloodbath. I need to short this market.
So they start selling.
And just like the stop-loss hunt, the institutions are waiting at the bottom to buy those sell orders.
Wow. By driving the price down, the institutions are actively accumulating all of those panicked sell orders to build their massive long positions at a discount.
Exactly. That morning drop is the manipulation. It's the fake move.
And once their massive orders are completely filled,
the real move begins. The algorithm shifts gears into the distribution phase where the price rockets upward in the direction of the true daily bias.
leaving all those early short sellers completely trapped underwater.
Exactly. So, as an informed retail trader, if you have a bullish bias, you are literally sitting at your desk at the open, watching the market turn red and rubbing your hands together.
Saying, yes, perfect, fall into the trap.
You're waiting for the manipulation to finish so you can ride the distribution. You are waiting for the rubber band to be pulled back so you can ride the snap forward.
Let's put some hard geometry to this manipulation phase, because T-Trades offers a very specific mechanical framework for visualizing this. He calls it the equilibrium or EQ framework. How does this work?
T-Trades suggests looking at the previous day's entire range, from the absolute highest tip of the top wick to the absolute lowest tip of the bottom wick.
A whole entire span of the candle.
Yes. You take that entire vertical distance and you draw a horizontal line right through the exact 50% midpoint. That 50% line is the equilibrium, the EQ.
What does that line represent conceptually?
It represents fair value. Anything above that 50% line is considered a premium price. Anything below that 50% line is considered a discount price.
Like buying a TV. You don't want to buy it at a premium, you want to wait for the discount sale.
Exactly. And institutions operate the exact same way. So for bullish continuation day, T-Trades outlines a highly specific sequence.
Okay, so the market opens.
The manipulation phase begins, pushing the price down. But how far down? According to this framework, price will drop into a discount by testing that 50% EQ line of the previous day.
It drops to the 50% mark and stops.
It respects it. It might wick slightly below it, but the bodies of the candles on your lower time frames will not close heavily below it.
So it taps the discount pricing.
Right. The institutions load their longs, and then it explodes upward, eventually breaking through the previous day's high. The simple mantra T-Trades uses for this is open low, high close.
Okay, so that's a continuation day. The manipulation tests the 50% mark and expands. But what about a reversal day?
That's a different beast.
Let's say we are looking for a bearish reversal today because yesterday gave us a bearish SOS signal. Does it still just test the 50% line?
No, the anatomy of a reversal is fundamentally different. In a reversal, the market must frame off the outer boundaries, the previous day's high or low.
Okay.
So if we expect a bearish reversal today, the market opens and pushes up. It pushes completely past the previous day's high.
Why past it? Why not just to it?
To execute the trap. By pushing past yesterday's high, it triggers all the buy stop liquidity resting above that high.
It tricks the retail breakout traders into thinking, we are breaking out to new highs, buy, buy, buy.
Exactly. The institutions sell into that buying frenzy, creating a shallow wick on the daily time frame, and then the market violently collapses back inward.
Often targeting that 50% EQ line or lower.
Yes.
But T-Trades gives a really fascinating warning here about failed setups. He says you have to pay obsessive attention to the size of the wick that forms during these reversal sweeps.
This is a crucial detail.
He says if a daily candle forms a massive, unusually long wick during a reversal sweep, you should absolutely not trade it. You need to stand aside and wait for the next day, what he calls candle 3.
Yes, candle 3.
Why does the size of the wick matter?
Yeah.
If it swept the liquidity, didn't it do its job?
This is where we have to think about market momentum conceptually, almost like physics. I'll use your rubber band analogy.
Okay.
When price pushes past a previous day's high and then quickly snaps back, creating a relatively shallow wick, that rubber band is loaded. The trap was sprung efficiently.
The kinetic energy hasn't been spent yet.
Right, it's primed and ready to fire in the opposite direction for the rest of the day.
A clean execution.
Yes. But imagine a scenario where the market pushes way past the high. It grinds higher and higher, spending hours up there fighting a brutal war between buyers and sellers, and only eventually, exhaustingly, drifts back down.
Closing inside the range.
Yeah. That creates a massive long wick on the daily chart.
What does that massive wick tell us mechanically?
It tells us the rubber band has snapped. The kinetic energy required to create that massive wick exhausted both sides of the market.
Oh.
The institutions had to expend far too much capital just to engineer the trap. There's no fuel left in the tank for a smooth, high-probability distribution phase.
So if you try to trade the reversal off a massive wick, you'll likely just get stuck in sideways, choppy, unpredictable price action.
The battle was too bloody. Both armies are dead.
Wow, the edge is gone. So T-Trades advises waiting for the next day, candle 3, to establish a new clean boundary, what we call a protected swing, before you risk a single dollar of your capital.
It's all about preserving capital.
Okay, this is incredibly helpful. We know how to find the direction. We know we have to wait for the manipulation phase to play out to get our discount entry. This naturally brings us to the next critical question. Where exactly are we aiming?
Location.
Right. Knowing the direction is only half the battle.
Yeah.
Knowing where to pull the trigger and where the market is trying to go is what keeps you alive.
Location is everything. You can have the right bias, but if you execute in the middle of nowhere, you'll still get stopped out.
J-Dub Trades has a very specific methodology for mapping this out. He says the first thing you do when you open your chart is box in the previous day high, the PDH, and the previous day low, the PBL.
The most important zones.
Yeah, and he says you literally draw a shaded box from the absolute tip of the wick down to the physical body of the candle. He argues these are the absolute most important zones on any chart, period. Why these specific zones? Why are they better than just drawing a random support line from 3 weeks ago?
Because markets are not driven by magic, and they are not driven by abstract diagonal trend lines that retail traders draw. Markets are driven by one thing: liquidity.
And liquidity, in plain English, just means resting orders.
Exactly. It means pools of money waiting to be executed. As we discussed with the stop-loss hunt, where do retail traders and even large hedge funds systematically place their protective stop-losses?
Just above yesterday's high and just below yesterday's low.
Those zones are objectively where the highest concentration of resting orders exists. If an algorithm needs to execute a massive block order, it must interact with those zones.
Lewis Kelly refers to this concept as magnetism. The market doesn't just wander aimlessly. It is magnetically drawn to these specific areas of high liquidity.
It's pulled toward them.
He points out 3 main magnetic targets that we need to be aware of: equal lows, equal highs, and unmitigated fair value caps, or FVGs. Can we ELI 5 each of these?
Sure.
Let's start with the equal highs and lows. Mechanically, what creates them and why are they magnetic?
Equal highs or equal lows occur when the price pushes up to a specific exact level, it's rejected, drops, and then later pushes up to that exact same level again and gets rejected a second time.
It creates a visually flat top or a flat bottom on the chart.
Like a ceiling.
Yes. And when retail traders read traditional technical analysis textbooks, they're taught that a flat top is a double top. They are taught it represents strong, impenetrable resistance.
Exactly. So what do? They heavily short the market, and they pile all of their stop losses directly above that flat ceiling.
Because they think it's safe. It bounced twice, it'll bounce a third time.
But to the smart money algorithms, that flat ceiling isn't a barrier. It's a neon sign indicating a massive concentrated pool of buy-stop liquidity. It is highly magnetic.
So the algorithm will almost certainly drive the price up to smash through that ceiling.
It triggers all those stop losses, absorbs the liquidity, and only then reverses. Equal highs and lows are engineered to be broken.
That is absolutely devious. Okay, what about a fair value gap? What mechanically creates a gap, and why does the market want to return to it?
A fair value gap, or an FVG, represents an imbalance in the auction process. Markets are supposed to be an efficient two-way auction between buyers and sellers, but sometimes a massive influx of institutional volume hits the market all at once.
Imagine 3 massive consecutive green candles shooting upward on a chart.
A huge explosive move.
Yes. During that explosion, the buying pressure is so overwhelmingly aggressive that it completely bypasses the sellers. There is no two-way trade.
The buyers just blast through the order book.
This leaves a literal gap in the price action where only buying occurred and no selling occurred.
And the market doesn't like that.
The algorithm is programmed to seek efficiency. It views that gap as an unfulfilled vacuum, so it acts as a magnet.
the market will naturally gravitate back down to trade into that gap.
allowing the sellers to participate and rebalance the auction before continuing its true upward trend.
I love thinking about this like a heat-seeking missile. The market algorithm is the missile. These pools of liquidity, the equal highs, the PDL, the FEGs, are the heat signatures.
So that's a great visual.
The missile is programmed mathematically to hunt them down. As a day trader, your entire job is to locate the heat signatures, figure out which one the missile is targeting today based on your daily bias, and ride the missile.
You absolutely do not want to be the guy standing in front of it holding a sign that says support.
Right. That is a phenomenal analogy. And this brings us perfectly into the institutional perspective, which is brilliantly captured in the TradingView SMC Pro script we have in our sources.
Yes. SMC stands for Smart Money Concepts.
This algorithm is designed to literally think like a market maker. What does the script actually do?
It forces patience mathematically. The SMC Pro script will not validate a trade entry. It will not flash a signal unless a directional liquidity sweep has already occurred.
Wait, hold on. So even if the indicators look good, the script literally refuses to give you a buy signal unless the market has already dropped and trapped sellers first.
Exactly. The algorithm is programmed to wait for the bull trap or bear trap to occur at these specific PDH or PDL levels we just talked about.
It enforces the rules.
If the price is just flating aimlessly in the middle of the daily range, the script stays completely quiet. It will not let you take a mediocre trade. It waits patiently for the missile to hit the heat signature.
Sweeping the stop losses below a major low.
Only then, when the trap is fully sprung and the smart money reversal begins, does it flash a valid entry signal.
It mechanically prevents you from being the liquidity.
Yes. It ensures you are entering with the smart money, not against them.
That is incredible. And that perfectly bridges us into the next major segment. We've talked a lot about the theory, the single candle, the manipulation, the liquidity pools. But staring at a naked chart trying to calculate all of this in real time is overwhelming.
It's exhausting.
We have this massive stack of advanced algorithmic TradingView scripts in our sources. They are designed to visualize all of this complex bias and manipulation so you don't have to guess. I want to try and translate these visual charts into audio because looking at these scripts is like looking at the heads-up display of an F-22 fighter jet.
It can be visually intimidating, but the logic behind them is actually very elegant.
Let's start with the hardest problem in trading. Multi-time frame analysis. Let me know if this sounds familiar. You open the 4-hour chart and it looks beautifully bullish.
Okay.
You drop to the 15-minute chart and it looks like a bearish bloodbath. You drop to the 1-minute chart and it's just moving sideways in a tight, choppy range.
Total confusion.
Your brain freezes. You have 3 different charts telling you 3 different stories. How do we fix that?
That analysis paralysis is exactly why the Alpha X Market Pulse script was developed. It is designed to solve exactly that problem.
Okay, let's break down Alpha X. It is described as a 5-time frame engine. It tracks the 1-minute, 5-minute, 15-minute, 1-hour, and 4-hour charts simultaneously.
All at once.
But here's the genius part. It doesn't just average them out equally. It uses weighted scoring. Explain how the weighting works and why it's necessary.
The Alpha X engine assigns a mathematical weight to each time frame based on its importance to the macro trend. The 4-hour chart holds a massive 30% weight in the final score calculation.
Wow, 30%.
The 1-minute chart, on the other hand, only holds a 10% weight.
Why the massive disparity?
Because it reflects the reality of market physics. The macro trend, the 4-hour chart, has more mass, more capital behind it, and therefore more inertia.
It's an ocean.
Yes, and the 1-minute chart is just a tiny ripple on the surface of that 4-hour ocean.
So if the 4-hour is roaring bullish, but the 1-minute is temporarily pulling back and looks red, what does Alpha X tell me?
Alpha X will calculate the weights and still output a firm bullish bias. By weighting the time frames, the algorithm physically prevents you from getting spooked out of a valid macro bullish trade just because of a minor, temporary, lower time frame pullback.
It keeps your eyes on the horizon. Okay, so it weights the time frames. But what is it actually analyzing on those time frames? The source material says it runs 4 separate computational engines simultaneously: trend, momentum, volatility, and volume.
A 4-cylinder engine.
I want to ELI5 each of these engines so you, the listener, understand what the math is doing. Let's start with the trend engine. It looks at a stack of exponential moving averages, or EMAs, specifically the 8, 21, 55, and 200. First of all, why those specific numbers?
Those numbers are derived from the Fibonacci sequence, which is a mathematical sequence deeply ingrained in nature and deeply respected by algorithmic trading models.
And what does the engine look for with these EMAs?
It looks for a perfect stack. An EMA calculates the average price over that specific number of periods, weighting the most recent data more heavily.
Yeah.
A perfect bullish stack occurs when the fastest moving average, the 8 is on top, followed by the 21, then the 55, and finally the 200 at the bottom, acting as the foundation.
So they fan out.
When they fan out perfectly like that, without crossing over each other, it mathematically confirms a smooth, uninterrupted trend.
Got it. Engine number 2 is momentum. It uses the RSI and something called the stochastic KD. I think most people know RSI is the relative strength index, measuring that something is overbought or oversold. But what on earth is a stochastic KD, mechanically?
The stochastic oscillator measures the current closing price relative to its price range over a specific period of time. It consists of 2 lines.
2 lines, okay.
The %K line, which is the fast line tracking the immediate price, and the %D line, which is simply a moving average of the %K line, making it slower and smoother.
So it's a fast line and a slow line. What is the engine looking for them to do?
It looks for divergence and momentum shifts. When the fast %K line violently crosses above the slow %D line while they are down in the oversold territory, it indicates a sudden aggressive shift in momentum back to the upside.
And the Alphic engine calculates that cross and scores it as bullish momentum. Okay, engine 3, volatility. It looks at Bollinger Band compression. I love the visual of Bollinger Band. They look like a cloud wrapping around the price. But mechanically, what are they, and why do we care if they compress?
Bollinger Bands are a volatility indicator consisting of a simple moving average in the middle and an upper and lower band that are calculated based on standard deviations from that average.
Standard deviation just measures how far the price is straying from the average.
Exactly. So when the market is highly volatile and making huge moves, the standard deviation expands and the bands physically bulge outward on the chart.
But the market cycles between high volatility and low volatility.
When the market goes quiet and price just chops sideways in a tight range, the standard deviation shrinks. Visually, the upper and lower Bollinger Bands squeeze tightly together, pinching the price.
The compression.
Yes. And in market physics, low volatility always precedes high volatility. A Bollinger Band squeeze is like a coiled spring. Energy is building up.
The Alpha X engine detects that compression and alerts you that a massive, explosive expansion is imminent.
And finally, engine 4, volume. It just checks if the big boys are actually participating. It ensures that the breakout isn't just retail noise on low volume, but actual institutional capital flowing in.
Correct. Volume validates the price action.
So AlphaX takes the EMAs, the stochastics, the Bollinger Bands, and the volume across 5 different time frames. Applies the 30% to 10% weighting, crunches all of that math instantly, and then outputs what it calls the verdict line on your dashboard.
The verdict line is the ultimate distillation. After doing millions of calculations a second, it simply spits out a text label on your screen.
Like high confidence long or high confidence short.
Yes, it hands you your daily bias on a silver platter, backed by math, not emotion.
But my absolute favorite verdict line from the documentation is when it outputs. Mixed stand aside. Oh, those 2 words, stand aside, could save millions of dollars for retail traders. When the AlphaX engine detects that the 4-hour trend is fighting the 15-minute momentum and the Bollinger Bands are flat and the volume is dead, it physically tells you there is no statistical edge in the market.
Because a coin flip is not a trading strategy.
Exactly. It's like having a veteran floor trader sitting on your shoulder, slapping your hand away from the mouse, saying, don't click it, it's a trap.
Okay, so AlphaX solves the multi-time frame analysis. But time itself is just as important as price. This is where the Enigma Sniper 369 script comes in. The documentation says it highlights kill zones. What is a kill zone?
Kill zones are specific, predetermined windows of time during the 24-hour trading cycle when volatility, liquidity, and institutional order flow are at their absolute peak.
When everyone is awake.
Typically, these align with the opening hours of the major global financial centers. The London session open and the New York session open.
Because that's when the big banks turn on their computers and start moving billions of dollars.
Precisely. You do not want to be trading during the dead Asian session lunch hour when volume is flat. The Enigma Sniper script physically draws a colored box over your chart to delineate these high volatility kill zones. It tells you, pay attention now.
But what the script does next, inside that kill zone, is super surgical. And I want to make sure I'm visualizing this correctly for the listener. Inside the kill zone, the script scans for a specific sweeping candle, the one that grabbed the liquidity.
Wait, the trap candle.
It then automatically draws a solid line exactly at the absolute swing low of that candle's wick. Okay, that makes sense. That's the absolute bottom. But then it draws a dotted line at the exact 50% mark of that candle's wick. I need an ELI 5 here. Why does the middle of the wick matter? Why the 50% mark?
In institutional trading logic, we refer to the 50% mark of a wick as the consequent encroachment. To a retail trader, a long wick just looks like empty space where the price was rejected. But to an algorithm, a wick represents incredibly rapid, aggressive price action.
It's like a miniature fair value gap.
Yes. It's an area where the market moved so fast that it wasn't efficiently traded.
So it's another vacuum.
Exactly. And because algorithms seek efficiency, the 50% mark of that massive liquidity-grabbing wick acts as a highly magnetic retest zone.
It comes back to fill the vacuum.
It is extremely common to see the market sweep a low, violently reverse up, and then quietly drift back down to perfectly tap the 50% mark of that exact wick before launching into the stratosphere.
The Enigma Sniper script draws that dotted line so you can place a limit buy order right there.
Yes. It gives you a highly precise, heavily discounted entry point. And the beauty of this geometry is that it allows you to hide a very tight protective stop loss just underneath the solid line, the absolute low of the sweep.
Because if it breaks that, the trade is dead.
Right. It mathematically maximizes your risk-to-reward ratio. You risk very little to make a lot.
I love how mechanical that is. Buy at the dotted line, stop loss below the solid line. But let's say I'm looking at a sweep, and I'm still terrified. My brain is telling me the market is just going to keep crashing through the solid line.
The fear is real.
How do I know the sweep was a fake-out manipulation and not the start of a real crash? This is where we bring in the final weapon in the digital arsenal, the Redindicator CX script, which tracks SMT divergences.
SMT stands for Smart Money Tool. It is, without a doubt, the ultimate algorithmic lie detector test for the market.
Let's unpack an SMT divergence, because this concept took me a minute to grasp. I'm going to use an analogy. Imagine two marathon runners chained together at the waist. Let's call them the NASDAQ and the S&P 500.
Okay, I like this.
They run at the exact same pace. They turn corners at the exact same time. If one runner suddenly trips and falls face first into a ditch, but the other runner is still standing perfectly upright, running smoothly on the pavement, you instantly know something is wrong. The fall wasn't real. The chain should have pulled them both down.
That is a brilliant analogy, and it perfectly describes how highly correlated assets function. The NASDAQ and the S&P 500 are tethered together by billions of dollars of algorithmic arbitrage. They should move in tandem.
They should make higher highs together, and they should make lower lows together.
An SMT divergence occurs when they temporarily break that correlation at a key liquidity level.
So practically, if I am sitting at my desk trading the NASDAQ, a market opens, the NASDAQ drops violently, it breaks a major previous daily low, it sweeps liquidity, my heart rate spikes. Is the tech sector crashing? Should I short?
But you pause.
But before I click anything, I look over at my second monitor showing the S&P 500 chart, and I notice that the S&P 500 did not break its corresponding daily low. It held its ground. It's still standing on the pavement. That discrepancy is the divergence.
And that divergence is the lie detector going off. It conclusively proves that the violent breakdown on the NASDAQ is a fake-out. It is a manufactured, localized liquidity sweep a trap.
Because if it were true, macroeconomic panic selling, both indices would have plummeted simultaneously.
Exactly. True selling pressure breaks all correlations downward. When the NASDAQ breaks its low, but the S&P 500 physically refuses to break its low, the S&P is revealing underlying institutional strength.
So the smart money is actually buying the S&P while they manipulate the NASDAQ down to grab stop losses.
That SMT divergence is your ultimate, undeniable confirmation that the NASDAQ's downward move is exhausted and an aggressive reversal back to the upside is imminent.
And according to the sources, this isn't just for stocks. This works perfectly in crypto, too.
It works in any highly correlated market. If Bitcoin violently drops and sweeps a weekly low, but Ethereum holds its low and refuses to break, that is a crypto SMT divergence. It confirms a bullish bias for both assets. The lie is revealed.
Okay, this is incredible. We have a theory of the daily bias. We have the maps of the liquidity pools. We have the digital cockpit with Alpha X and Enigma Sniper doing the heavy lifting. Now let's get our hands dirty.
Let's do it.
Let's put this all together into a real-world scenario. Let's walk the listener through a perfect top-down execution, step by step, using the specific gold, or XAUUSD, example detailed in the Trading Hub transcript.
This is where we synthesize all the theory into a repeatable mechanical model.
Okay, step 1. Establish the daily bias. We open the daily chart for gold. We see that yesterday, gold pushed down, wicked below the previous day's low, triggering all the sell-side liquidity stop losses, and then violently rallied to close bullish with the body back inside the range.
So based on what we discussed earlier?
Our bias is officially a bullish reversal. The SOS signal is flashing bright green.
Excellent. The macro weather forecast is sunny. The institutions have trapped the sellers. But crucially, we do not just instantly buy gold at market price.
Right, we need a discount. So, step 2, finding the 15-minute point of interest, or POI. We drop down to the 15-minute time frame. We wait patiently for the Enigma hyperscript to draw the kill zone box, indicating the London or New York session has opened and institutional volume is present.
High volume is key.
During that high volatility window, we watch the price of gold pull back, dropping down into an unmitigated order block that formed during yesterday's bullish push. Let's pause here. ELI5, an unmitigated order block. What exactly is that on the chart?
An order block, in its simplest definition, is the last consecutive down candle before a massive, aggressive upward move that breaks market structure.
So if I'm looking at a chart, it's the final red candle right before a giant explosion of green candles.
Yes. But mechanically, why does that red candle matter? Because that red candle is where the institutional smart money injected their massive capital to initiate the buy program. They left a footprint.
But wait, why is it unmitigated?
However, because the subsequent upward move was so aggressive, they likely couldn't get all of their desired orders filled at that initial price.
So they have leftover unfilled buy orders sitting there.
Precisely. And it is unmitigated because the price has not yet returned to that specific level to trigger those remaining orders. So the 15-minute order block acts as an incredibly strong magnetic point of interest. You want to see price drop back into that specific red candle zone.
Okay, so the price of gold drops into our 15-minute order block. The alarm bells are ringing. Are we buying now?
Still no. And this is the hardest part for retail traders to accept. Blindly setting a buy limit order at a 15-minute POI is a great way to catch a falling knife.
Why? If the location is right.
You know the location is right, but you need to see the institutional footprint actively reacting to that location. You need confirmation.
Which brings us to the final trigger, step 3, the 1-minute confirmation. We zoom all the way into the 1-minute chart. We are inside the 15-minute order block. The Trading Hub source is very strict about the exact sequence of events that must happen next. We have to wait for the 1-minute price action to sweep an inducement. What is an inducement on a 1-minute chart?
An inducement is a lower time frame trap. Imagine the 1-minute chart is trickling down into our 15-minute zone. It creates a small, localized swing low, bounces up slightly, and then heads back down toward that low.
Retail scalpers see that small bounce, draw a trend line, and put their stop losses below that 1-minute low.
They're being induced to play early.
Exactly.
The algorithm induces them to enter early, creating a micro pool of liquidity. We must watch the price drop and sweep that 1-minute inducement low.
It has to run their stops.
It must. And immediately after sweeping that 1-minute low, the price must violently shift upward, breaking the local downward structure. Trading Hub refers to this exact moment as a CISD, a change in state of delivery.
Change in state of delivery. Explain the mechanics of that phrase. What is being delivered?
Order flow is being delivered. Before the CISD, the algorithm was in a sell-side delivery state. It was programmed to aggressively deliver the price downward to hunt liquidity. The CISD signifies the exact mathematical millisecond that the algorithmic program terminates sell-side delivery and switches to buy-side delivery.
It flips the switch.
Yes. When you see that violent structure shift upward on the 1-minute chart, right after sweeping an inducement, inside your 15-minute POI, which is completely aligned with your daily bullish SOS bias, that is when you strike.
That is when you execute your trade. All the stars, macro and micro, are perfectly aligned.
That is a symphony of confirmation.
But execution means nothing without risk management. Where are we placing our safety nets for this gold trade?
Your stop loss is placed strictly, mechanically, and without a shred of emotion, just below the absolute 1-minute swing low that was created during the inducement sweep. If you are using the Enigma sniper script, it's right below that solid line we discussed earlier.
Why there? Why not give it a little more breathing room?
Because if the price goes below that specific sweep line, your entire premise for the trade is scientifically invalidated. The algorithm didn't actually shift to buy-side delivery. You were wrong.
And when you are proven wrong, you do not hope, you do not pray, you do not widen your stop loss.
You take the small predefined loss and you move on.
And for the take profit, where are we aiming?
You aim high. You can use the Fibonacci extension tool, drawing from the bottom of the 1-minute impulse to the top and targeting the mathematical 1.618 extension level. Or even simpler, you target the opposing previous day high.
Because remember the heat-seeking missile analogy. We are riding the missile from the discount order block all the way up to the premium liquidity pool resting above yesterday's high. You let the algorithmic magnetism blow your trade into massive profit.
Couldn't have said it better myself.
Okay, I have to ask the painful, realistic question. Let's say we do all the prep work. The daily bias is bullish. The 13-minute order block is identified. The price perfectly taps into our zone. We drop to the 1-minute chart. Our finger is literally hovering over the mouse. Our heart is pounding. And price just keeps dropping.
It happened.
It never sweeps an inducement. It never gives us that violent CISD structural shift upward. It just slowly bleeds out right through the bottom of our zone.
This specific scenario is the dividing line between amateurs and professionals. This is where amateur traders lose their shirts because they feel a compulsive need to force a trade. They think, well, it's close enough, I'll just buy it anyway.
Yeah, totally.
The professional trader watches it bleed out, simply smiles, closes their laptop, and goes for a walk.
They just walk away?
Yes, because the absence of a signal is a highly valuable signal.
Oof, that's good.
If the 1-minute trigger never fires, the trade is mathematically invalid, period. Furthermore, if you were to glance at your AlphaX dashboard during that bleed out, you would see the 1-minute and 5-minute engines screaming bearish momentum, creating a severe conflict with your daily bullish bias.
The verdict line would read, mixed stand aside.
By strictly demanding that lower timeframe CISD structural shift, you physically prevent yourself from catching a falling knife. You preserve your mental capital and your financial capital for a setup that actually aligns.
Which is the perfect transition into our final section, part 6, psychology, risk management, and the stand-aside protocol. Managing the charts is one thing. Managing your own brain when real money is on the line is entirely different.
I always say technical analysis is 10% of trading. Psychology and strict risk management are the other 90%. You can have the best strategy in the world, but if you lack discipline, the market will take all your money.
Let's talk about Lewis Kelly's approach to risk to reward, because his math is what allows professional traders to survive the inevitable losing streaks. He operates on a strict 1-to-5 risk to reward ratio. He gives an example in his transcript of risking $4,000 on a single trade with the explicit goal of making $20,000.
Let's do the math on that 1-to-5 ratio because it fundamentally alters how you view losses. If you risk 1 unit of capital to make 5 units of capital, you can literally be wrong on 70% of your trades and still be a highly profitable trader at the end of the month.
Let me make sure I'm hearing that right. I can be wrong 7 out of 10 times and still make money.
Yes. Let's say you take 10 trades, risking $1,000 per trade. You lose 7 trades. You are down $7,000. But the 3 trades you win, you make $5,000 each. That's $15,000 in profit. Subtract your $7,000 in losses, and you walk away with an $8,000 net profit, despite having a terrible 30% win rate.
That completely removes the psychological pressure of needing to be perfect.
Exactly. You don't need to predict every move. You just need to be right on the macro direction occasionally, wait for your highly specific, high probability setup, and execute with a mathematically tight invalidation level that stop loss tucks safely below the sweep.
If you get stopped out, you lose 1 unit. You shrug it off.
If it hits your target, you make 5. It turns trading into a statistical casino where you are the house.
But to consistently get those massive 1-to-5 trades, you need expansion. You need the market to actually move, which brings up a heavy warning from JW Trades about avoiding the chop. He says ranging markets will destroy this strategy. What defines a ranging market in this context?
A ranging market occurs when the price is essentially trapped. It is just bouncing like a ping pong ball between the previous day high and the previous day low without having the institutional volume to break out of either boundary. If you look at the daily candles, they look like a series of tight doji candles, small bodies with wicks on both ends moving sideways.
The climate is completely neutral.
Yes, the daily bias is neutral. And trying to apply trend trading strategies inside a tight range is incredibly dangerous. We call it mean reversion. If there is no clear macro direction on the daily chart, your 15-minute order blocks and your 1-minute triggers will fail repeatedly.
Why?
Because the institutional volume simply isn't there to drive the massive expansion you need to hit your 1 to 5 target. The missile has no fuel.
So how do we know when the fuel's running out? Let's say we are in a great trade, we caught the manipulation, we got the exact dotted line on the Enigma sniper script, and price is flying up. Everything looks amazing. But this is where the Institutional Order Flow Pro script becomes your best friend.
A brilliant script.
This script tracks volume and something called delta. I need an ELI 5 on delta because this sounds incredibly advanced.
Delta is the ultimate truth teller of market aggression. While standard volume just tells you how many contracts were traded in total, Delta breaks it down. Delta is the net difference between aggressive market buys people hitting the ask price and aggressive market sells people hitting the bid price within a specific candle.
So if there are 1,000 market buys and 800 market sells, the delta is positive 200. It shows who is hitting harder.
Exactly. It measures the aggression. Now, the Order Flow Pro script calculates delta z-scores. A z-score simply measures how extreme a data point is compared to its historical average. So an extreme positive delta z-score means there is an historically massive amount of aggressive market buying happening right at that second.
Okay, so I'm in my long trade, price is pushing higher, and I see a massive extreme positive delta z-score. Tons of aggressive buyers. That's a good thing, right? I'm going to the moon.
Not necessarily. This is where you have to look for a specific phenomenon called absorption. Let's say you see that extreme positive delta. The buyers are aggressively buying with everything they have, but you look at the price chart, and the price has physically stopped moving up. It is completely stuck.
Wait, if they are buying aggressively, why isn't the price going up?
Because of absorption. Imagine you are driving a sports car and you press the gas pedal completely to the floor. The engine is roaring, that's the aggressive market buyers. But your car isn't accelerating, in fact, it's struggling to move forward. Why? Because attached to the back of your car is a 2-ton titanium anchor.
What is the anchor in the market?
The anchor is massive institutional limit sell orders resting invisibly in the order book. The retail buyers are aggressively hitting the buy button, but those massive institutional sellers are just absorbing all of that buying pressure, swallowing it whole without letting the price rise a single tick.
So the buyers are just exhausting themselves against a brick wall.
Precisely. When you see extreme positive delta, massive aggressive buying, but the price refuses to move up, the trend is exhausted. The institutions are capping the top. That is the warning siren. That is the exact moment you suppress your greed, stick to your trading plan, take your profits at your Fibonacci level, and exit the market immediately before the massive reversal crushes you.
It takes so much incredible psychological fortitude to execute all of this. You literally have to sit on your hands and wait for the daily candle to close to get your bias. You have to wait out the agonizing manipulation phase while your screen bleeds red. You have to wait for the 15-minute POI tap, and then you have to wait for the 1-minute CISD confirmation. And if you get in, you have to watch the delta to know when to jump ship. Impulsive trading, just clicking because you're bored, destroys this edge entirely.
Boredom is a day trader's worst enemy. You sit at your desk for 3 hours, nothing aligns, and you feel like you should be doing something. You feel unproductive. So you force a low probability trade in a mixed ranging market just to feel the dopamine hit of being in the game.
It's a disaster waiting to happen.
The true mark of professional discipline is accepting that actively standing aside, actively choosing not to trade, and preserving your capital is a highly profitable, strategic decision.
All right, let's bring this all home and summarize this incredible journey. We started with the weather map. You cannot trade the noise of the 1-minute chart. You have to find the macro signal. You check the previous daily candle for a simple continuation or for a powerful liquidity sweeping SOS reversal. You refuse to buy the open. You wait for the morning manipulation phase to intentionally drive the price into a discount equilibrium or into a key magnetic liquidity zone like the previous day high or low.
You align your time frames using algorithmic logic like the Alpha X engine to ensure you aren't fighting the macro trend.
You wait for the Enigma sniper kill zones. And you execute only when the 1-minute chart confirms the structural shift with a sweep and a CISD, placing your stop loss strictly below the trap.
If you follow that mechanical, rules-based framework, you essentially eliminate 80% of the emotional guesswork from your trading. You stop gambling and you start executing like a casino.
But as always on the deep dive, we want to leave you with a final provocative thought. Something to chew on after you take off your headphones and stare at your charts tomorrow morning.
Consider this. As traders, we spend so much time obsessing over the hyper-micro timeframes. We zoom in closer and closer, looking for the secret to the markets and the chaotic minute-by-minute fluctuations of price. But what if the ultimate truth of algorithmic trading isn't found by zooming in, but by zooming out? What if the single, quiet, daily candle that you ignore every morning already holds the entire predetermined script for the day's action?
It really makes you look at that daily chart with a whole new level of respect. The story is already written, you just have to know how to read it. Now it's your turn. We want to hear from you. How do you determine your daily bias? Do you rely on single candle closures, complex multi-timeframe EMAs, or something else entirely? Drop your experiences, your favorite setups, and your worst psychological hurdles in the comments. We'd love to hear how you navigate the chop. Until next time, keep diving deep, keep zooming out, and trade smart.